So this is what your deliverable is going to be like in this order. The booklet, the cover page, the stock and the oil, your homework problems you cover. Don't forget to sign the date. What day you get it.
What do you mean cover?
Cover page, just like you have on the deliverable.
Make one for the study question?
Yep, exactly. So everything is like a separate thing. And is this 12-point type? Right here. Yeah, you want to use 12-point and then narrow the top margin and narrow the bottom margin.
It's whichever
Yeah, narrow the top, narrow the bottom, and then it'll
for us, with that sheet you gave us, not the thing that's or
and then go back to
something.
12-point.
It's those problems from the book.
I'll just like have your work.
These are not stock price, stock
And then that
tickers.
needs
These
its
are
own like cover
indexes.
page too.
All of them?
Yeah,
So
so I'm
like
gonna
how
get
the
rid of
deliverable
those.
has
This
And then I'm-
so obviously there's a problem there, but
Yeah, that's
we're
fine.
getting its
And
own.
then you've got Jones,
Okay.
Jones,
What was
put that over there.
what would
You should be right,
for that?
right justified
Uh,
in the result,
Whichever date we're turning is, whatever next Thursday is.
like this.
10?
Over there like that. Dow Jones. And then that
But it's
goes
like
over
inside the
there.
deliverable as
So
well.
it's right
Yeah,
justified
so it'll be right
in the
with the
cell.
problems.
Got it?
Justify everything in the
Yep. And then are these ETF tickers? Okay, and then these need to be in upper lowercase. Okay, upper lowercase, upper lower, upper lower, upper lower. Okay, and then this is, don't read that, upper lower, upper lower. Stock prices forecast to rise, 3% rise, so up. Buy forwards, buy futures, buy calls on futures, or puts on futures, got it. Buy on margin, buy calls, and write puts, got it. And then these are the same as those. Okay? And then here it has to say, therefore we recommend the following 36 trades, colon. Do you have a template? Do you have a memo template?
No, I mean,
So you need this one, right there, and you need that one down there. This is above, period. This is following, and a colon.
oh, and this is correct, the
Yeah.
rate?
Yeah, exactly. And I'll give you this. Okay. And then let's start with that, okay?
But otherwise it's,
Yeah, you're really close. Now you're ready to do, actually that should probably be a little bigger.
bigger?
Yeah, like that size. So I'm
I
gonna
already
do,
did my other one too.
okay, cool. So just make those adjustments to that one too. And then it should be in pretty good shape. Then I'll actually read it once the formatting is done. So when you hand it in on Thursday, I'll write some notes on it to correct any of your grammar. Okay. All right.
Is the cover page fine now?
I don't have time for that right now, so I would consult one of the experts over here. Okay. All right. So let's do the last. And if I have to,
I'm not gonna be here.
hold on. Did I gonna be here on Tuesday or Thursday? Thursday? Can you come early? Tuesday or Thursday?
I could come early Tuesday, I just can't come out.
Yeah, what time?
Tuesday?
Yeah.
How early do you want me to be?
What time do you think?
I could get
You can't do Thursday?
No, I have.
No, I just want to make sure I do this correctly.
Oh, do
I
you?
wanted to
Okay.
print it out.
As early as you want, I'll meet you
Is
here at any
this
time.
I could get here at
a lot of the real estate companies are doing the opportunity zones, so the timing's good. They're marketing it pretty. Cantor Fitzgerald is in that space these days. Okay. Okay, thank you. All right. Sorry, guys. I have to do two things. Okay, so break out your blue books. Do you guys have blue books? You got enough blue books? Okay. How much time do I have?
About an hour.
How much? Okay, so let's do it. This is exactly how I would draw it, okay? So you want to draw it exactly like this. Okay? Okay. So this is the microeconomics of investment portfolios. And you've done some of the stuff already, so now what we're doing is we're taking some of the stuff from the pre-tests, or piecing the puzzle together. Okay. Now we're doing the application. All right. Now, this analysis is how investment managers look at constructing portfolios. Okay. So I can construct a portfolio of just stocks. Yep. Yeah, I heard you. I heard you. I can construct a portfolio of just stocks. I can create a portfolio of just bonds. I can create a portfolio of just real estate. I can create a portfolio of stocks, bonds, and real estate. I can create a portfolio of stocks, bonds, real estate, and insurance. I can put together a portfolio of stocks, bonds, real estate, insurance, and energy, which is your, this is all you guys, right? The next 30 years, building out energy assets to basically reconstruct the whole global economy, or else we're all going to, go up in flames if we don't. Right? But there's going to be trillions of dollars invested in that space. So, your career could go in that direction, just like my career is going in that direction on this conference call right now. So we're working on that right now, multi-billion-dollar fund to basically deploy technology on site at power plants to basically do compute for Google and Amazon. Okay, so we're talking about a multi-billion-dollar, maybe $1 trillion opportunity here on a global basis. Okay, so the question is, how do investment managers think about constructing these portfolios, and what are the impacts? Okay, so this is right here on the x-axis. It's a portfolios. This is this one. Yes, modern and postmodern portfolio. And this is an area that I've been working on for years. Okay. So this is the portfolio standard deviation. You calculated this on your pre-test. Okay. And then over here, this is the expected return on the portfolio. Okay. And the expected return on the portfolio is pretty easy. It's just, what are the weights? How's the portfolio weighted? And then what's the historical return been? So you calculate a weighted average. Okay. So it's pretty simple. And the weights added to 100. Right here, you put the dot right there, and you go like that. Capital allocation line, okay, or what is called the CAL. Okay. You guys got to be taking notes. I mean, really good notes. This is one of the hardest problems.
Can you repeat what the X and Y axes are?
Yeah. So this is your x-axis. This is your y-axis.
No.
This is the portfolio standard deviation, this is the expected return. When you hear portfolio standard deviation or variance, it means risk. Okay? So as you go out here, it means higher risk, higher volatility in the returns for the assets within the portfolio.
So that's
So this is the expected return.
risk.
It's the portfolio standard
A
deviation.
variance, it means variance also.
Variance, standard variance, take the square root of the variance, gives you the standard deviation. On your pretest, you have the portfolio standard deviation equation. Okay? So when you hear standard deviation or variance, it's risk. Okay? So high risk, you go this way. High return, you go that way. Okay? Right here, this is called the risk-free rate, right here, that point. The risk-free rate, we usually start with the 10-year treasury yield. And where's that trading right now? That was on the exam. Where's the 10-year trading right now? Probably like 1.8 or something.
1.53.
1.53, so it's pretty low.
Yeah.
So that's basically your base rate, okay? Okay, got it. Any other questions? Okay, then what I would do is I'd go right here. Put a dot right there. And then go like this. Like that, and like that. Okay, these are called utility curves. So these are basically, and actually in the book, and you guys worked on some utility curves. It's basically, you know, when I buy a stock portfolio, I want high utility, right? I want low risk and I want high return. Does that sound right? Is that your ultimate objective? Yeah. This is where investors want to be, right? High return, lower risk, or do they want to be right there? High return and zero risk? Would that be awesome? Yeah, but unfortunately there's no assets, you know, available in the marketplace that I can put together as a portfolio that's going to give me a high return and zero risk. There's nothing. Okay? So me as an investor, I'm going to have to take on some risk, and if I'm going to take on risk, I want to be compensated with higher return. Okay? So I'll take risk, but I got to be compensated for it. Okay? So investors want to be here, but they can't. So what they do is they lower their utility. To the point where this utility curve is tangent to the capital allocation line. So when they come together, it's called tangency. Did you take trig or finite math or calculus or, yeah. So we talk about tangency. Then the next thing that you do is you go right back to the dot again, and you go like that. And then this one goes like this, but it stays above the risk-free rate. Okay? Okay. That's called the efficient frontier umbrella. looks like an umbrella. Okay. And then what you want to do is you want to put a dot here, a dot there, 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 there. So you want to put some dots along the efficient frontier. So these dots along the efficient frontier are portfolios I can construct, okay, for my investors. And then these are the individual assets that are available in the market that then I can construct into portfolios which become the dots. Okay. So these dots are the portfolios, the dots inside the portfolio are the assets that I can construct. Okay. This point right here is 100% stocks. And this point right here, the portfolio is 100% bonds. Okay. And obviously stocks are more volatile, right? Okay. Stocks are down like 100 today, they were down like 200, they were up like 200. So they move around a lot. So they're more volatile because they're very sensitive to news items. See, stocks get high return. We also have high risk, high portfolio standard deviation. Bonds provide you with significantly lower risk, but also provide you with lower expected return. Okay, so that's how I would set it up. Okay, and actually, the point here, this is point M, which is the market. That's the market basket right there.
The capital allocation.
There's the capital allocation line. This point right there is the market basket. And I'll explain what that is in a second. This will all make more sense as I go through. This point, the expected return on the portfolio, star next to it. And this is the portfolio standard deviation, the star next to it. This is the point where you get the highest expected return for the given level of risk. Okay? And this point here is the expected return on the portfolio divided by the standard deviation of the portfolio. This was on your pretest. Is the risk adjusted rate of, is the risk adjusted rate of return. Okay? Because you take your return and you divide it by the standard deviation, that risk's adjusted. That adjusts it for risk. It normalizes it. Because this is a unit of return divided by a unit of risk. So that's your risk adjusted rate of return. Okay? All right. You can move up. Actually, what you can do is you can jump off. You can jump off the efficient frontier and move up. The capital allocation line to a higher expected rate of return. But a significantly higher level of risk, standard deviation. Okay. And the way that you jump off the efficient frontier and up the capital allocation line is through margin. Remember on your memo, buy on margin? You're basically borrowing from the brokerage firm and buying more stock. So you're leveraging your position. I want to buy $200,000 worth of Apple. I only have $100,000. I'm going to borrow $100,000 from the brokerage firm, and I'm going to leverage up my position and buy $200,000 worth of Apple. So leverage is a two-edged sword. Your return on equity, the equity is the money that you invest, your money that you put in. But then when you apply the loan, it leverages up the return on equity. So if the stock prices go up, your return goes like that. But if the stock prices go down, your return goes down. So leverage is great when prices are going up, but they're horrible when prices go down. So they're a two-edged sword. Okay. If I have an investor that wants a high rate of return, what we do is I take their money and I borrow as much as I can and invest all that money. So we're leveraging up the amount of money that they have. And we can do that through margin. On my stock portfolio. And I can also use mortgage. And mortgage on my real estate. So if you buy a house, I don't know, down here on Atherton Avenue, I mean, you can, you know, it costs you $15 million, you only got $5 million, you're gonna have to come up with the other 10, you borrow it from the bank. Okay, and it does the same leverage effect. Okay. I can also jump off the efficient frontier and move down the capital allocation line. Let's say to here. Let's say to here. Okay. And this is my expected return on lending. And this is the portfolio standard deviation from lending. Okay. So this is what banks do. Okay, banks can jump off the efficient frontier and move down the capital allocation line to lower the risk in the portfolio. They're going to lower the return, but they're more concerned about lowering the risk. I can also move up the efficient frontier and down the efficient frontier. Okay. So let's say I want a higher rate of return and I'm willing to take on more risk. So what I can do is I can start selling off my bonds and start increasing my allocation to stocks. So I can do that too. I can also move down the efficient frontier if I want to lower my risk, and I'm going to get a lower return in the process. So I sell off my stock and I start buying more bonds. I start selling off my bonds and I start buying more stock.
And then would your risk go up?
And when you're buying more bonds, your risk goes down and your return goes down. When you're lending, like a bank, your returns go down, but your risk goes down more. Okay? And the reason why the risk goes down more for the bank that's lending or the brokerage firm that's lending out the margin is that the margin account is collateralized, the loan is secured by the stock. So if the price of the stocks go down, the brokerage firm will call you up and say you need to put up more money. If you don't put up the money, they will sell the stock and pay off the loan. Same thing with the real estate.
Wait, what was his question?
Huh?
What was his question?
He was asking about the lower return, lower risk for the bonds and the lending.
Oh, okay.
He thought it was higher return, but no, it's lower. The bonds and the lending have lower return and lower risk. The margin and the mortgage, along with the stock, higher return, higher risk.
Okay.
Right? And then my other point was here, banks like to loan on real estate properties. Okay? You don't own the properties until you pay off the mortgage. Okay? So the property secures the loan. It's the security for the loan, backed by the property. The loan is backed by the property. So if you stop paying the mortgage payments, they go into default. The bank is going to foreclose on the property and they're going to take the property. That's why these provide lower risk. It's because you can take the assets and liquidate them to pay off the loan. Okay? You got it? Okay. So now, let's talk about the market basket. What is it? Okay. What is it? Well, it's changed over the decades. Okay. As new assets are introduced into the marketplace, the composition of the portfolio changes. Okay. So if I've been around and working in this business for 80 years, right, since post-World War II, I would have been advising my clients on different types of market compositions as new assets were introduced over time. Just like alternative renewable energy is now the product, the new asset class, and it's going to become more dominant, going out over the next 30, 40 years. But if you go back 80 years, it was very different. This market basket was different. Okay? And what did it look like? Between 1945 and 1970, when investment managers were putting together portfolios for their clients to save and invest and accumulate so that they could retire or leave their wealth to their clients, it was 70% bonds and 30% stock. So this was your portfolio allocation. This is what we were. If I wanted to replicate the market, this would have been my recommendation to my clients. And then in 1980 to 1990, a company called Ibbotson and Associates basically ran all the mathematics around this and noticed that real estate's returns were not very correlated to stock and bond returns. So if they added real estate to the portfolio, they could gain more diversification. Okay. So they said, well, since real estate has cash flows from the rents, plus, you can sell the property, at the end of the period at some point, it acts a lot like bonds. Okay. So they took from the bond allocation. And they found out that all investors should have 10% of their wealth allocated to real estate. Okay. And actually, Congress passed a legislation called ERISA, which was a labor law that basically stated that public and private pension plans should have at least 10% of their pension fund money allocated to real estate. So that institutionalized this portfolio strategy. Okay. And then in 1990 through 2000, Ibbotson did some more research and found out that not only should we have 10% allocation to real estate, but we should also have 10% allocation to life insurance, particularly whole life insurance, permanent insurance. And then you would have 30% still in stock, and you would have 50% in bonds. And you know, all the wealthy families have life insurance, okay? Because it's a very powerful tool to pay off debt and taxes and leave a ton of money to your beneficiaries. And then, from 2000 to 2019, a company called Reef Funds. Reef Funds. This was a big investment advisor. Did all the analytics, just like Ibbotson did, and came up with a recommendation, another recommendation, and said that pension funds and institutional investors and investors like yourself should have 10% of their allocation to alternative renewable energy. Solar, geothermal, biogas, wind, all the renewables. That's where we're moving, right? Because we're not doing coal, and we're trying to get away from oil, right? Because it's all carbon. So that's what they came up with. And they also said, keep the 10% allocation to life insurance. Keep the 10% to real estate. Keep the 30% to stock. And reduce the bond portfolio again to 40%. So these are the market baskets that basically have evolved over the last 80 years. And this is your future right here.
So as more assets get added, it goes more up?
I'll show you.
The risk is higher, right?
I'll show you what happens. Now these assets right here, you guys are on the right thing, but you're going in the wrong direction. These are called alternative assets. These are called alternative assets. And the returns from these alternative assets have low, no, and negative correlations. The returns on these alternative assets have low, no, and negative correlations with stocks and bonds. And that's what's made these asset classes, these markets, so popular over the last 10 years, where a ton of money has gone into it. There's been money going into these for at least the last 30 to 50 years. Life insurance was invented like 167 years ago. But this is a new asset class. This is new. Where are you from?
From Austria.
Austria. Yeah. So Eastern Europe, Western Europe is huge. They've been, with the Green Party, have implemented and brought renewable energy assets and markets. They've been focusing on that for the last 50 years.
But why is it always 10%? Is there a reason behind it?
Because it was the mathematics. Okay, so they ran the mathematics around this, and the model pumped out these results. Okay. Because the markets are smaller for these than these, and these are more established assets. They probably should have more in here, but the model basically kicked out these results. Okay, so it's a model-driven result. And this allocation right here, this portfolio allocation, is called the model target portfolio model target portfolio allocation.
That.
Yeah, these weights. And you notice how they all add up to 100? Is everybody following so far? This is your advanced financial microeconomics. Okay. This is key. Right? Hopefully you remember this the rest of your life. Go ahead.
And what are going to be the next alternative assets? Like, is there any predictions?
You know, I really don't know.
Are there going to be more of them?
You know, theoretically, right, as the asset classes have been introduced over time, maybe we're in 2020, what's it gonna be in, you know, 2100, right? And, I mean, you guys will be around by then, right, because you're gonna live for 110 years. No, seriously. I mean, with healthcare and everything, and unless, you know, the pollution and stuff kill you, or it's a war or something, theoretically, your generation could live until they're 100. So what's the odds of a new asset class emerging in the next 80 years? Probably pretty high. I don't know what it is, but I know that this is the target allocation that I've been making recommendations on for the last 10 years. And now with, you know, California going to almost 100% renewable, you know, Europe's moving in that direction, China's moving in that direction. There's, you know, billions and trillions of dollars that's going to be plowed into that asset class.
And so if you invest in these asset classes, it's going to be like more profitable for you, right?
The returns will be there, but there's going to be lower risk. So the returns on this asset class is comparable to real estate and somewhere in between stocks and bonds, but lower risk. Okay, and this is the key. How much time do I have?
About 20 minutes.
Okay, perfect. I'll be able to do this later. This is the key, is that these asset classes have no low and negative correlation with stocks and bond returns. So if I add these to my stock bond portfolio, you need to write this down because this is what I'm looking for on the exam. I go right here, okay? If you add these alternative assets to your stock and bond portfolio, because they have low, no, and negative correlation with stocks and bonds, which means, let me do this for you so you understand. So there's stocks. These are bonds, right here. So stocks and bonds are correlated. Their returns are correlated to each other. They move with each other. Okay? But these other assets may have, their returns may have negative correlation. So they move in the opposite direction. Or they may have no correlation whatsoever between stock and bond returns. Or they may have low correlation with stock and bond returns. So if I add these alternative assets into the portfolio, because they have low, no, and negative correlations with the stock and bond returns, this is it right here. What happens is that it flows out the efficient frontier. It flows it out.
What What does the green line represent?
This one right here,
Low correlation?
yeah, this is the negative correlation.
It goes up.
This is negative correlation.
What does it go up?
Hold on, we got one question. No correlation. And this one is positive, but it's low. Low correlation. So if I add these assets to my stock bond portfolio because they have low, no, and negative correlation, it bows out the efficient frontier, which means that it pushes it that way. Okay, it pushes it that way, bows it out. Makes it go like this. So it bows it out like that. And what it does, because the rates of returns are lower for these alternative assets, it reduces the expected return on the portfolio.
When it's low correlation, it reduces the
Yeah,
expected.
if I add assets to my stock bond portfolio whose returns have low, no, and negative correlation with the stock and bond returns, what happens is it bows out the efficient frontier. Okay, it bows it out. It lowers the return on the portfolio, but it lowers the risk of the portfolio more. So this goes down more than this, which means that this, the risk-adjusted rate of return, goes up. That's what investors do. Okay? And if I can get my investors 8 to 10% rate of return, because that's what they want. Investors want 8 to 10% rate of return, period. Okay? Risk-averse investors, the majority of investors, just want an 8 to 10% rate of return. Now, you may be different. You may be a risk lover. You're neutral to risk. You don't care. You're going for as high a return as possible. That's not the majority of investors. The majority of investors just want 8 to 10%. So if I can get them 8 to 10% rate of return, and I can add these alternative assets into their stock bond portfolio that have low, no, and negative correlation with their stock and bonds, it's going to bow out the efficient frontier. Yes, the expected return is going to go down, but the risk in the portfolio is going to go down even more, which means that the risk-adjusted rate of return is going to go up. That's my job. That's what I get paid for. Okay? I get paid a lot of money to do that. So based on the rule of 72, this is the rule of 72. If I can get my clients 10% rate of return per year, I'm going to be able to double the portfolio in 7.2 years. And that's what they want. So if I can lock this in at 8 to 10% rate of return, and introduce these alternative assets into the stock bond portfolio, and reduce the risk even more, and increase their risk-adjusted rate of return, they're happy. What's going to happen is money is going to come to me as an investment manager. And I'm going to be managing billions of dollars under management. And I'm going to charge them a fee. So if I'm managing $1 billion portfolio and I charge 1%, what am I making per year? Huh? 1% of $1 billion. How much am I making? What is it? Say it. 10 million bucks. Can you live off that? Yeah. Can you live off of 5? Yeah. So I give 5, I give the rest to the government, I give the other to the company I work for. I walk away with 5 million, can you live off that? Yeah, can you live off 2.5 million?
Yeah.
Yeah, can you live off 1.25, 125 million? No, this is the scale of the money, this is what I'm talking about. That's why you're here, okay, studying this stuff. It's called scale, okay? That's what you're trying to get to, okay? That's where you're trying to go, because you're here, right? In Atherton, in the Bay Area, so you take advantage of it, all right? This is how business people think, okay? If you know how they think, you can be part of the conversation. And if you're part of the conversation, you can be part of it, okay? And then start to move towards your career, and then make enough money to take care of your family, okay? And be happy, and leave stuff for your grandkids and your great-grandkids, which is the goal. Which gets to the next point, okay? The life insurance is key to this whole thing, okay? Now, I get a lot of people that I've talked to over the years, very unsophisticated people, that basically say that I don't believe in life insurance. I don't have it. I can beat the market. I can take the premium and basically invest it in the stock market and beat the market. If you can do that, that's great, but 90% of most investment managers can't even beat the market. So how are you going to beat the market? You must be smarter than 90% of the professionals out there with CFAs, master's degrees, PhDs. So you may be, I don't know, you must be brilliant. But the life insurance is key. And let me give you an example. I have a female client. She's worth $50 million. She sits on multiple startup company boards. She's worked for multiple startup companies. She sits on nonprofit boards. She's got her own nonprofits. She basically manages the family office for her family and friends, right? So that there's huge responsibility that this individual, this one individual, has to manage the family money, the family, nonprofits, the for-profits. So if anything happens to her, what happens to all of that? Yeah, it could go down, it could be destroyed, it could be impaired, it could be something that really bad could happen to all the institutions that she's managing and all of the protection that she's put together for all these people. So one way to hedge her mortality risk is to put life insurance on her, okay? Because if anything happens to her, it takes out all of the personal debt, the business debt, covers all the taxes. There's plenty of money there to hire people to take over for the tech companies, for the boards, for the nonprofits, to run the family office. So basically it maintains the institutional structure that she has worked her whole life to basically build. And what's amazing about the life insurance is when the death benefit goes into the portfolio, okay? The death benefit goes into the portfolio. The expected return on the portfolio jacks onto a higher utility curve, and the beneficiaries and the heirs and the stakeholders around her end up on at a higher expected return. Isn't that where everybody wanted to be at the very beginning of this lecture? Yeah, so life insurance is really the only vehicle, the only product that I know of that can get the investor onto a higher utility curve at a given level of risk. Yes.
Doesn't that also only happen with a death, though?
That's correct.
Okay.
Yeah. But do you really care about your own mortality at the end of the day? I mean, really?
I mean, a little bit.
Maybe, a little bit, right? But don't you care more about your family and people around you
Sometimes.
and leaving a legacy? Yeah,
Would
maybe.
hope so.
So this is the way we think, okay? We're building institutions that basically will take care of a lot of people in the process. And we care more about them than we care about ourselves. So basically our path in life is to basically create things and wealth to be able to help more people, particularly our family. And the life insurance does that. Okay. Now here's the weird thing about it, is that most people that I know that are in college, your age, do not have life insurance. Okay. $1 million worth of life insurance for 30 years, $400 a year. Right? That's your beer budget for a month, basically, right? So a premium is basically a beer budget right? A month's worth of beer. So think about that. Think about that.
That's for you.
$400 a year for 30 years. Okay. Level premium term insurance. It'll expire at the end of the 30 years. But if anything happens to you, leukemia, diabetes, cancer, car accident, murder, any of those things, basically your family is going to be taken care of. And your family, let me just finish this point and then we're done. I know this is a tough subject and you might think it's funny, but you guys are adults. Okay? It's time to take responsibility for your life and the people around you. You will be able to take care of your family for $400
You should die.
a year. Yeah, but do you care? You're going to die anyway. But here's the problem. No, but here's the problem. But here's the problem. How much and how much effort have your parents put in for you to get you here? What did they have to do to get you here? To a really good private school in the middle of one of the nicest places on earth. How hard did they work? If something happens to you, why are they sending you here? Why are they sending you here? They think you're going to do what?
Make money.
Yeah, you're going to go on and be successful, right? And some of you, your parents are actually looking to you to help them out when they get old. And what happens if something happens to you? What do they get?
Nothing.
Zero. So take responsibility for yourself and your family. Get the life insurance. Okay? I don't care if through who, but do it now. Okay? And if you think you're going to go into high tech and become a startup person, they're going to require that you have life insurance. So I'm not giving you $5 million and something happened to you, I'd amount $5 million. So you better have the life insurance. And if you have a pre-existing condition, you can't get the life insurance. So you get it when you're young and when you can get it and when it's cheap. Because after the fact, you can't get it and that's it. Then you're going to have to invest your money in the stock market and try to beat the market and self-insure yourself to leave something to your family. Because if you don't have the life insurance and you have a pre-existing condition, and I get people come to me all the time, tell me about the life insurance, Larry, that sounds amazing, I really need it, I just got diagnosed with cancer. And it's like, I can't get it for you. You should have gotten it basically a year or two ago when I told you that you should get it. Go ahead.
So what happens if you outlive the life insurance? Is there like a
You can buy, up until about 50 years old, like I can buy $1 million worth of life insurance for 30 years for about $4,000 a year, because I'm healthy. So that's still pretty cheap. And what's the payout? I'm like 60, 70, 80, 90, what's the probability that I'm gonna live to, 90? Probably a lot less, right? Maybe not for you, but for me. So basically I can pay this, I can pay the money for over time with a high probability of paying out and make sure I take care of my nieces and nephews and all my kids and stuff. And maybe leave some money to college and stuff like
So you
that. So
mentioned
it's cheap,
that
it's cheap.
You need a life insurance to have a startup too?
They'll wanna know what either if you have the money, if you have the life insurance, they're gonna say, I'll tell you what, we'll give you more equity in the company if you give us, a portion of your death benefit. Because if something happens to you, we want to be compensated.
Yeah.
Because we're giving you $5 million, right? I want at least a $2 million life insurance policy so that we can be compensated if you do something stupid. Or if if something happens to you over the next 5 years.
So you can really get that life insurance policy at
Yeah, you leverage it. Think about it. You're basically leveraging. You're buying $1 million, right? Payout. Unfortunately, you got to die, but it's $1 million asset that you're leasing for 30 years. It's $1 million. And if you buy whole life insurance, you build cash value in the policy. So as you pay the premium, it's building cash value. You can borrow on that tax-free. The death benefit can go to your heirs tax-free. So it's a tax vehicle. Not only is it an investment vehicle, but it's also a tax vehicle. And when you go to buy a house, if you have whole life insurance and you have cash value, they look at that as equity, and you have a higher credit score, and you're higher probability you're going to get the loan of other people who don't have the whole life insurance. So it's a brilliant, it was invented 167 years ago. I think it's the most brilliant financial product ever invented. Ever invented. So the term insurance is good to cover everything if something happens. The whole life insurance is an investment vehicle. And if you think insurance is stupid, tell that to the rich people on the East Coast, in LA, and in Silicon Valley, and in San Francisco, because they all got it. So they must be pretty stupid, right, to have it? Right? Yeah, right. I know you're pretty freaking smart.
So the more money you have, the more you're gonna get back from
Yeah,
life insurance.
right.
Yeah, so if you open your life insurance, buy whole life insurance, and build all that.
I know, every
cash
show
out,
is like,
it's like,
it's like,
The life insurance is
I don't even have.
zero.
Yeah.
Like,
Yeah, it's like,
Listen, man.
you make more money in the
Yeah.
the actual real premium goes down in real terms. So it's brilliant. If you guys need any life insurance, let me know.